the goal of decentralized exchanges is to like improve upon centralized exchanges. And one thing is a lot of people who worked at centralized exchanges DM'd me and said like, hey, these ADL like repeated events have happened before at centralized exchanges. But no one knew because you can't really see it, right? There's no public data. You only see yourself getting ADL. You don't see other people, so you can't measure like how big of an event it is.
Not a dividend.
It's a tale of two clans.
Now, your losses are on someone else's balance sheet.
Generally speaking, airdrops are kind of pointless anyways.
Unnamed trading firms who are very involved.
I like that ETH is the ultimate constant.
DeFi protocols are the antidote to this problem.
Hello, everybody. Welcome to the Chopping Block. Every couple of weeks, the four of us get together and give the industry insider's perspective on the crypto topics of the day. So quick intros. First, you got Tom, the DeFi maven and master of memes. Hello, everybody. Tom is at a party. Apparently, he was too cool to show up on time. Next, we got Tarun, the Giga Brain and Grand Poobah at Gauntlet.
Yo.
And joining us today, we've got special guest Vlad, leverage legend and leader of Lighter. Welcome back to the show, Vlad.
Wow.
Hey guys, yeah, good to join for the late night session.
That's right. That's right. Actually, it is very late at night right now. And I'm Haseeb, the head hype man at Dragonfly. We are early stage investors in crypto, but I want to caveat that nothing we say here is investment advice, legal advice, or even life advice. Please see choppingblock.xyz for more disclosures. So welcome to the late night version of Chopping Block, brought to you by the Chopping Block crew. So we brought Vlad on the show today because there's been a lot of drama going on in Perps land specifically. So right at the end of the last show, we were actually running up on time, and we got some angry letters from our viewers that we gave very short shrift to Tarun's ADL paper. So Tarun had just recently released a paper on ADL. ADL stands for auto-deleveraging. This is a process that happens when basically a market is moving really crazy fast in a perps market, and it must forcibly close out positions in order to deleverage the market. This is called auto-deleveraging, and it's a very edge casey kind of thing. But of course, it happened repeatedly across many, many different venues on October 10th, which was the big day where we saw the largest number of liquidations in crypto history. So Tarun, being the kind of dutiful researcher that he is, wrote a paper trying to analyze what's going on in the world of ADLs. And this is a space that has not been given very rigorous academic attention. And so I think Tarun, as far as I know, is the first paper, you can correct me if I'm wrong, the first paper of its kind that's been written on the subject.
There's one paper, there's one paper before me, but I don't think it formalizes ADL itself, but it does kind of formalize what BitMEX did, which is made by Kyle Soska, who is the chief CIO at whatever Flood's fund is called. I forget.
Okay.
But
well, there you go.
Yeah.
So you released this paper, I think, soon after the last show. And immediately after you released this paper, it triggered a firestorm. So there was all sorts of angry people. So I should note that one of the headline claims in your paper was that Hyperliquid over-aggressively auto-deleveraged traders to the tune of hundreds of millions of dollars in counterfactual P&L that was lost by traders or something. Correct me at any point if I'm mischaracterizing what the claim in your paper was.
Yeah, I mean, I will anyway later walk through the exact thing once you
okay, great.
explain the story.
Can't wait. Okay, so the Hyperliquid crew, led by Jeff, the founder of Hyperliquid, who's been on the show, Jeff tweeted in what is now an infamous tweet. I think he said, "Those who can do, those who can't FUD." And basically said, Tarun's paper is total garbage. Can't believe these are the people you look up to as academics. This is bullshit. Nothing in this paper is correct. Totally mischaracterizes how Hyperliquid works. Tarun then clapped back and said, wait, no, that's, you guys are misunderstanding my paper, blah, blah, blah. Then Dan Robinson from Paradigm, also a big investor into Hyperliquid. They ran the big Hyperliquid DAT. Dan Robinson from Paradigm came out and said, Tarun, I am also fellow academic. You are totally wrong. And the two of them just started sparring for about a week of just going back and forth and dueling threads, mostly in latex, describing each other as morons in various different ways. So it was kind of a battle of the titans. It seems to now have been resolved. So for whatever reason, all of the conflict that was going on between the two of them, now apparently you're best friends. And Dan Robinson announced that he was going to be helping some of the data analysis of the V2 of the paper, incorporating some of the feedback and corrections that many people from the community ended up giving you. But it sounds like it was a very harrowing week for our hero, Tarun.
Yeah, my eye bags are, for those who actually watch on YouTube, my eye bags are much larger than normal.
Yes. The misadventures in talking about ADL. So Tarun, tell us, how's your week been?
It was like I posted that. We recorded. I posted that, and then I got on a flight to Abu Dhabi, and I didn't have internet on the flight, so I landed, and then I saw the Jeff response. So like I hadn't realized the commotion that had happened. There'd been a little bit before I boarded, and then when I landed, I was like, oh wow, I caused a shitstorm. I think it was good. It was a good lesson in like how research has changed in crypto, in my opinion, over the last 5 years. Like 5 years ago, you read a paper, people are not immediately like, oh, you're fudding my bags, like get the fuck out of here. You wrote this research strictly for fudding, right? Like whereas like now it's like immediately assumed that you invested in Lighter or Drift or whatever, so you must be fudding my bag. So that was annoying, but I think like broadly speaking, I just kind of think the attacking thing is like kind of gone a little crazy the last few weeks. Like I think, for instance, there's been like lots of other research kind of trying to attack Polymarket, and Haseeb and Tom, maybe when Tom's here, he can talk about that as well. That there's sort of a sense in which some of it feels a little bit unfair, targeted, especially when there's like things have real merit and things that don't. But the idea that all research is marketing and that the marketing is like exists only to FUD someone, I think is somewhat disheartening, because you can't really write anything without getting people mad. Now, I will try to explain in the simplest terms possible, like what I stated, what I got wrong, and like what is still right. So Haseeb mentioned auto-deleveraging and sort of this edge case event. And so for me, October 10th was sort of like a crazy, very crazy day. I think I talked to Vlad like right after, and I was like, it's like kind of insane that ADL was triggered 20 times in a row or whatever. Like you just don't see, it wasn't invented to be triggered multiple times. And on October 11th, there was a thread by someone who I think this is their first ever tweet thread that at least I recall, which is Don Wilson from DRW, who large market maker, very big TradFi HFT player, does a lot of stuff. Person I have a lot of immense respect for. And he had a very good poignant point, which is like, if crypto can't fix ADL, if they don't make it so that it's friendly for traditional players, we're just going to have the FCM system, which is like the clearing system that we have in normal TradFi, where you have these counterparties, these third parties, who basically you have to effectively custody with in some indirect way, and they take the risk of these kind of rare events. Like they can lose their capital, but then you have to pay them fees to do that. And I think that tweet thread just made me say, like, feel this thing about decentralized exchanges, which is, okay, we have to have something that's better than this. Otherwise, like, yeah, if we end up in the FCM land, then we're just basically back to centralized exchanges, because FCMs, again, it's like, it effectively means someone custodies your assets. And so actually a couple of weeks before I put out the paper, while I was still working on it, Arthur Hayes wrote this really good blog post about the history of liquidations and ADL in perpetuals markets. I highly recommend. He has a lot of posts that maybe are just like price posts, but this one is actually like a history of like why the perpetual future became, had certain things in it that it did. And so the history of ADL is in 2015, Huobi, the exchange, added this algorithm for dated futures, like futures that expire monthly, effectively. And what had happened is, prior to 2015, Huobi had basically said, hey, if you get into this, so ADL is basically when no one can liquidate a position profitably, effectively. And so the exchange, in order to stay solvent, has to take some of the winners who have positive profits to cover some of the negative profits. So it's sort of, if I'm a winner, I made $100 on the exchange, but there's this person who has negative equity, sort of like their profit is much less than the collateral they put, and no one is willing to liquidate it. Then me as the winner, I socialize the loss. I cover some of their loss. And that is sort of at a high level what this like loss socialization type of thing is. It's just like in a case where you can't remove insolvent positions, you take money from the winners and try to regain solvency. So Huobi before that,
it's also opposed to like the old school loss socialization is literally everybody gets a haircut, right? Like the loss is split pro rata among everyone. That used to be the way that it worked before ADLs became the predominant way that it's done. One analogy that I've given to somebody who's like very not in crypto about ADL is that it's a little bit like when a company declares bankruptcy. It's like a stop the world, nobody move. We are now going to reorganize the debts to make it so that this company can like start operating again. And then it's like, okay, great. Now we've cleaned everything up. Now this company, it's too bad, so sad that you didn't get everything that you wanted, but the company's in bankruptcy, and you set it out in the world again. And if you have to, if immediately after you send a company out after bankruptcy, it declares bankruptcy again, it's kind of like, okay, this is really not designed to do this. And I think that's kind of the core of what Tarun's paper was getting at. If I can give my, kind of 90 IQ.
No, that's actually a good analogy. I like that. The interesting thing, just in hindsight, is Huobi apparently was pre-2015 was just paying out. Like the exchange took the risk on their balance sheet. So when the bad debt happened, they would just cover it with their profits. And then apparently some event happened in 2015 where they just like lost so much money. And there was sort of moral hazard. And Arthur's post talked about other exchanges where this happened, where by the exchange, everyone knowing the exchange would pay out, people started taking riskier and riskier positions because they were like, the exchange is going to cover it anyway. It's like heads I win, tails you lose type of thing. So anyway, I was sort of this mindset that like, hey, if this can't happen again, like, and people have basically, and so Huobi invented this algorithm, BitMEX adopted it for perpetual futures in 2016. And then Binance copied it in 2019. And then since then, it's kind of effectively been the standard where you order all the positions from largest to smallest according to some metric. And, the metric varies a little bit, but most places it's the profit times the amount of leverage. And then you start haircutting people one by one until you cover the bad debt. Now, the goal of the paper is like, hey, are there other methods we could use that would do better? Like, are there other algorithms that you could do? And so the paper shows there are other algorithms. There's also trade-offs, like some things you can never fully get rid of, like this moral hazard type of stuff. As an exchange grows, you're inevitably going to have that. And also some notion of fairness to traders. This algorithm I just described, where I order them one by one and then knock them out, is kind of unfair to the top person, right? Like if I'm the top trader by leverage and P&L, I'm the first one to get cut out. And I think this was actually on social media, a lot of the complaints about ADL was like, some people certainly made money. They happen to have the right direction, but some people happen to have the wrong direction and where they felt penalized for that.
Vlad, I want to bring you in from what you saw from both what happened on 1010 and like your learnings in terms of how Lighter implemented ADL, and also from your discussions with Tarun. What do you take away about the design space of ADL that we've learned or that you've learned personally?
Yeah, I mean, I think that Tarun's paper, to me, like there was a lot of like interesting analysis of how different algorithms could work, and simulations of those algorithms in different scenarios. Like I think there's a lot of cases to think through, right? Like this algorithm where kind of like this greedy algorithm, right, where you start with like the biggest profits, biggest positions. I mean, that from a certain perspective, that makes sense. On the other hand, like if you're doing some kind of like pairs trading position where you're long ETH, short BTC, then that algorithm isn't very fair to you, right? Because like you've actually, like you have this one leg of the trade that did very well, and maybe you could say, well, you could take a bigger haircut than other traders, but you actually had a full loss on the other side. So I mean, I think to me, like part of the point of the paper is like it's you can't necessarily design a perfect algorithm. So there's also the question of like, I guess from where we sit at Lighter, like we want to verify that everything we did is fair, and so and to do that, we have to compute all of these claims and kind of generate ZK proofs of them. So we like if the algorithm is too complicated, that creates other problems, and that you can't really prove it in anything close to real time. So our algorithm actually is also pretty heuristic based. I guess one difference is that it's just less aggressive. So
It's not the vanilla Q algorithm that
it is. I mean,
with?
I think it is similar to that as well, but there's parameters to it, right? It's like there's the queue, but then there's a parameter of like when do you start pulling from that queue. So you can kind of use the insurance fund, which for us is the LLP, like up to a certain point, and then only after that do you start pulling from the queue. So that there's parameters like that as well. I think like in a perfect world, if the computational throughput wasn't a factor at all, then probably some combination of the kind of the greedy algorithm and the socialized algorithm would be best. But there's from our perspective, there's also the computational aspect to consider. But in general, we've tried to make the system kind of just like friendlier to traders, and I think you saw that on October 10th. But
You mean that with respect to LLP taking on some of the liquidations as
Yeah.
opposed to rejecting them? Yeah.
That's right.
Yeah.
That's right. And I mean, LLP did take a hit that day, but a lot of traders didn't have losses that they would have had otherwise, right? In fact, like I think we've made this point before, but LLP was down 20 million that day, but that also means all the other traders collectively made 20 million since perps are zero sum. So, and by now, LLP has made most of that back as well. So, if something like that happens every 5 to 10 years, that's from our perspective, that's the right trade-off. But I think that's a little bit of an orthogonal point about. Yeah, go ahead.
Yeah. Well, one of the points that we were making on 1010 is that part of the reason why 1010 was so disruptive was because it was very unpredictable, right? People who thought they had hedges in, those hedges exploded. And a lot of this, of course, is because you can't just net on a single exchange and understand what somebody's exposure, what their risk profile is. Because if I'm super long on Hyperliquid, but I'm super short on Lighter, or vice versa, you can't tell in isolation, oh, this person is like, oh, this person looks really risky, but in reality, they're taking what they think is like actually a very safe position across two exchanges. But the moment that you blow out one of their hedges on one side, all of a sudden now this person is taking a lot of risk and they start going topsy-turvy and all sorts of chaos ensues. And so it felt like this is one of the points I think that Anand made in response to your paper, Tarun, is that one of the most important things is just predictability. Is just the ability for large traders, market makers, people who are doing carry trades, for them to be able to understand and predict when ADL is going to happen and what happens to their positions on net when an ADL takes place.
Yeah, look, I don't disagree with you. I just think, or with that claim, I just think there hasn't been many open source implementations. The documentation for this doesn't, if you read everyone's docs, they don't really lay out what they do. And I think, the controversy is because of how I estimated the number, because I made a mistake in the paper where I haircut the entire position, so profit plus principal, versus just haircutting the profit. And like it turns out that the space of algorithms doesn't change. So all these like improved algorithms that the paper claims like still work in the profit space. But generally speaking, the winners on Hyperliquid were over collateralized in the sense that they had 13% of their positions were P&L on average. So I sort of overestimated roughly by a factor of 7. I'm working on getting the exact number, but you can roughly think of like there is the paper said 650 million. It's probably more like 100. But there's still this amount that was over liquidated by this algorithm, and like fundamentally, I think that that is a sense of unpredictability, especially if you can't verify the state of the algorithm, and because it's not open source, there's no explicit description of what the code is doing. It just kind of tells you, I'm going to rank you and then liquidate you. And to Vlad's point, there's a ton of parameters to that. How you do those, when you maybe go to a liquidity pool like an LLP or HLP, the timing, like how aggressive you are. Maybe you instead of fully liquidating, you partially liquidate. There's so many parameters that if you don't see the source, you don't really know what's going on, right? So I think that's certainly why the .HLs went after me and still are. But I think there's still a fundamental directional truth, right? Like, even if the magnitude was wrong.
Well,
like,
I mean, the other reason is because also you're an investor in Later. So, which I think you mentioned that, but just to underscore it even more, that's a big part of the reason why they went after you.
Yeah. But I want to kind of underscore one final thing, which is the goal of decentralized exchanges is to like improve upon centralized exchanges. And one thing is a lot of people who worked at centralized exchanges messaged me, DM'd me and said like, hey, these ADL like repeated events have happened before at centralized exchanges, but no one knew because you can't really see it. There's no public data. You only see yourself getting ADL. You don't see other people. So you can't measure like how big of an event it is. But I talked to some people from Huobi who were working at Huobi 2016 to 2018. And they said this occurred multiple times, and Huobi just paid people out. So like it basically reverted to insurance fund once they did the ADL, and then if it's sufficiently large, they had enough complaining traders that they paid them out. And you can't really do that in decentralized exchange, right? And I think that's sort of why you need
can
it.
do all sorts of stuff if you are sufficiently motivated. You've been
Yeah,
in
that's
DeFi long
fair.
enough. Like, your token is an insurance fund is like the meme, right?
That's true. I guess like maybe that's fair. But it's interesting that this was the first time you could see this event, right? Like we should kind of be
And that's to Hyperliquid's credit, is that like, okay,
Yeah.
maybe you can't read the exact ADL algorithm, but you can see all of the ADLs. You can see the record of this person was closed at this price at this time on this chain. Otherwise, you wouldn't have been able to do this analysis at all.
Yeah, exactly. And I think like that's already an improvement.
The other element of this, of course, is that you were sparring not just with the Hyperliquid.HLs, you were sparring in particular with Dan Robinson. And like, I want to ask you about that because the fact that Paradigm was a big investor in Gauntlet, wasn't it?
Yes. Still
Yes.
are, I guess. Yeah.
Still are. Yes, presumably still are. So any reflections on getting into a sword fight with your lead investor?
I guess you recently had a podcast series about the same type of thing.
Did I? Wait, what? Wait, who did I get in a sword fight with?
Santiago.
Oh, with Santi. Oh, that's true. Yeah. Okay, I'm his. Okay, yeah, you're right. Actually, you're totally
right. Isn't that the same kind of?
Yeah, that's
thing?
right. That's right. Fair enough.
I just think, obviously, I'm not trying to create more beef. I have my own opinions and thoughts as to what motivated the level of aggression, but I won't share them. But I think things could have been handled differently. But I don't know. At some level, I'm just kind of happy. I'm it's over because like it was just a lot. Because I feel like I spent 2 months doing this as a labor of love, and like there's nothing I expect to get. There's nothing I expect to get out of it, right? It's like I'm not.
Right.
It's like literally a public good, and I feel like I was like you know that meme of like the open source software developer who like there's like 500 people in their GitHub issues saying like, why didn't you fix this thing? Why didn't you fix this issue? And it's like this person did this for free.
Yeah.
And like is not really gaining much, is in fact only losing based on the last week.
Okay.
So.
There's two elements of it, right? Like one is that it's like that saying from The Wire, you come at the king, you best not miss. Is that like, look, you come after Hyperliquid, like you better come correct. You better bring the receipts. You better like have all your shit together. So that there's a part of that that's true. There's another part of that like, yeah, people don't know what the culture of crypto was like before the kind of modern token industrial complex, like in a way, it's almost like, I feel like there's a little bit of, I don't know, like think like pharma research, right? Like I could not imagine reading pharma research and not just being immediately jaded. They're like, obviously this person is fucking paid by pharma to like get some result. They're like, oh, antidepressants are like great. And I'm sure there was some time when like people were just in pharma research for the love of the game and people were like experimenting on themselves and like, oh, I wonder if this thing will reduce my dandruff and like their haircuts on fire. Like that, there was a time when that was like actually how it worked. And I remember when you were writing papers about DeFi, like about like the staking rate versus like the organic yield that was on chain and how that produced instability and consensus. Like you were writing papers like that. It wasn't like, oh man, why are you running a compound? Or like, oh, why are you talking shit about MakerDAO? It was just, yeah, we didn't know. And so we were all exploring this like giant terrain together. And now it's like, well, everyone's got a bag. Everyone's got, and look, it's different now. You're an investor. And so it is genuinely different. And like, we have genuinely grown up and we are in the pharma era. So like, you kind of got to respect it. Like, yeah, you can't pretend to be the guy, putting dandruff thing on his own head and just being like, oh, what do you know? Look, Head and Shoulders is the best dandruff shampoo. It's like, okay, well, you gotta know how people are going to perceive it. So I can see both sides. That's my.
I clearly did not know that, and I was really, I will say, I was mainly inspired by, like I said, this Don Wilson tweet because like he's been around a lot, right? He lived through March 12th, 2020, which in TradFi had a number of really crazy events, including one where like these people who are supposed to post collateral on your behalf, these FCMs, a bunch of them went bankrupt, and trading firms who were profitable went bankrupt because the person who's supposed to post collateral on their behalf for this kind of lost socialization didn't, and then the exchange closed everything. Vlad and I both know some people who are indirectly hit by this kind of blow up, and I think it shows the weaknesses in the TradFi system too, right? So Don has seen that, and I think he has probably the best perspective of anyone in crypto because he's been on both. He's kind of been in crypto for a while, right? Like Cumberland's been trading here forever, right? So he's kind of seen this grow up. So I just like had a lot of like his statement basically felt like this almost existential thing, right? Which is like either you fix all this shit or we're just going to go back to FCMs, which is like kind of a sad, to me, that's like if crypto ends up just with FCMs, like these like clearing agents, like that's sort of just like a sad ending for derivatives. Like the point for bearer asset self-custodial stuff is like, you don't need that, right? You shouldn't need that. And to me, that's like fundamentally the main thing I was kind of cared about and why I kind of went down this rabbit hole.
Vlad, what's your take? FCMs, is that FCMs bearish?
Yeah, I mean, I think there's definitely it's an interesting problem, right? It's a hard problem. I mean, I think there's different solution spaces here, right? Like I think, for example, like options, like maybe like one thing I've always wondered about is like why isn't there more emphasis on options and decentralized markets? Like I think options would actually make some of this stuff cleaner in the sense that you could take leverage in ways that aren't going to bankrupt the whole system. So I mean, I think that may be one area that there'll be more of a shift towards in the coming year. But also, yeah, I think having I do think this kind of research is a public good, right? I mean, I think understanding this further, like certainly like our team, when we looked at the research, like we learned a lot, and it'll influence how we think about like future versions of as we iterate on the ADL algorithm. So yeah, I mean, I think, and yeah, it's like people who have positions on different exchanges. Even within a single exchange, you may have positions of correlated assets or like spot versus futures. Like I think that it's these are hard problems, and we'll I think having I think Haseeb, your point about like ADL, that this shouldn't happen very often in the first place, right? I mean, I think that's part of what we're trying to get to as well.
So today, speaking of should not happen, today we had another day of leverage wipeout. It was something like $400 million that was wiped out today in terms of leverage. But it does seem like in terms of the on-chain volumes are hitting a fever peak. A lot of this is driven by anticipation of Lighter's TGE, which I believe is coming soon. And again, fair notice, both the Dragonfly and Robot are investors into Lighter. Right now, you guys are the number one exchange by 30-day perp volume as well as 7-day perp volume. There's some markets right now in Polymarket that are anticipating when the airdrop is going to take place, supposedly at some point over by the end of the year. But who knows? Polymarket obviously seems to be fairly confident in that. And there's been some news, I guess, recently about some new. Well, so there's been some conversation about the fee model of Lighter, which seems to come up again and again. So just to reiterate the way that Lighter works. So Lighter, unlike Hyperliquid, in Lighter, there are two ways that you can decide to trade on Hyperliquid. One of them is with zero fees. But if you're paying zero fees, you have increased latency. So there's like a quote unquote speed bump that you're paying if you're not paying, if you're incurring if you are a normal trader. If you want to pay for lower latency and API access, there's like there's a pro, what is it? I don't know what it's called, but like
the premium
special tier. Premium tier. There's a premium tier that you pay for that does charge fees if you want to be able to trade faster. And this is where more pro traders tend to trade. And so with this structure, so Lighter is become quite profitable. It's making significant revenues as an exchange, but it's doing so despite the fact that for a majority of retail traders, they're actually on there paying zero fees. And this is, I think, part of the reason why it's attracting quite a bit of volume in addition to the anticipation of the airdrop. So talk to me, Vlad, about, I've seen a lot of people going back and forth about how they feel about this pricing model. Do you think this is where crypto trading is going? There's been a lot of comparisons, like, well, Robinhood kind of did the same thing where they introduced zero commission trading and they kind of took over the old school brokerages, which all charge commissions. It's a little bit different. It's not exactly the same thing, but it kind of rhymes. Talk to me about how you see the pricing of fees in crypto perps.
Right. Yeah. I mean, I think, I was thinking of something Tarun said earlier, which is like for in the ADL context, it's like, I guess Huobi tried it and other exchanges copied it. I feel like that's kind of how I feel about the fee models of that that have existed for, I don't know, the first 10 years of perps trading, where they've all been kind of pretty much the same. There hasn't been much innovation there, even though in TradFi, as you said, with Robinhood and others that followed, there has been a lot of innovation there. Like I think for us, like I think there are like kind of three reasons for this fee structure, right? One is philosophical, kind of like democratizing finance. I mean, that's part of why we started building Lighter in the first place. Two, right, like when you think about two-sided markets, right? If you have kind of retail and you have professional trading shops, like the professional trading shops, they'll adjust. Like the harder part of the marketplace to attract is the retail. I mean, retail has a lot of options. Like they there are a lot of products they can try. Like the whereas like the professional trading shops, they're active on many exchanges. Like if they're making 100K a day trading on Lighter, and then now they have to pay premium fees, now they're making 80K, like they're still going to stay, right? Like that's still, they're running a business. As long as it's profitable, they're going to keep doing it. So that's the kind of second reason, right? I think third reason is it actually, I think, is like better for the market in the long run, because it expands the universe of traders and possible trading strategies when you have the zero fee tier. Like maybe there's some traders who wouldn't be in the market at all, but now they're in the market and they're doing like scalping, or maybe someone who's retail is now, maybe they would have been trading once a day and now they're trading 3 times a day, right? So it's like if you expand the opportunity set, I think that's better in the market, for the market in the long run. But how exactly that'll play out, like I think we are seeing some of the other builders in the space experiment with fee models like ours or other variations of that. But how will that play out? Is it going to take, like even with Robinhood, right? I think it took 5 years before other major players started to try their fee model. So like I don't know if it's something that we'll see like a very immediate shift from the
I mean,
rest of the
crypto
industry.
moves much
Yeah,
faster than
yeah,
any other industry I've seen.
it's
So,
true. It's true.
like the time it
But
took from like BitMEX to Binance, or like from, old school BitMEX contracts to like Binance completely changing the game was like a year and a half.
right. Yeah,
Tron
no, yeah, it's
ICO.
true. But I guess it would be like kind of presumptuous to say, oh well, in a year, this will be the state of play for the whole industry. But I mean, we certainly believe in it, right? And we're gonna
Mm.
continue. It's nice to see, because I think like 6 months ago when we talked about this, it was kind of theoretical and it was like, oh, this will never work, right? And it's similar to when I remember in the early days of Robinhood where I was an advisor, like same kind of feedback. So it's nice to see that it's actually, at least so far, working, right? But now that we've added Spot, right, that's also interesting, right? Now some of the stuff we're going to be working on, we are working on, that we're going to be releasing soon, right, is like you'll be able to do, I mean, you can already trade Spot for free now, right? But like with native bridging to and from Ethereum, like it'll open up some interesting possibilities there too. And I think part of like, why, because right now we only have one asset on Spot, which is ETH. I mean, that's going to change soon, but even with that asset, like there's been some pretty healthy volumes. And yeah, I think the fee structure has a lot to do with that.
So beyond that, let's also talk the product roadmap, because one of the things. So right now, Hyperliquid, de facto leader. Although right now both you guys, Aster, have been leading in volumes in terms of open interest, they still remain the king. They recently launched Trade XYZ, which is their RWA trading platform. You can trade on, you can buy NASDAQ perps, you can buy Tesla perps, et cetera. Doing pretty significant open interest at this point. My understanding is that you guys also have your own offering on that front, as well as Hyperliquid just announced cross margin, allowing you to margin the same account with not just USDC, but also I believe they just added Hype as the other margin asset, and they plan to add more over time, is my understanding. And you guys also have cross margin on your roadmap. Give me a sense from like sort of the inside baseball, because now it used to be that basically Hyperliquid totally dominant, left everybody else in the dust, right? Like them versus DYDX or them versus synthetics or whatever. It was kind of just it was really like BitMEX versus everybody else. Now it's a horse race. Now it really does feel like there are a lot of credible players in the same market, and there's a lot of product competition in terms of features and trying to keep parity with each other and stay at the vanguard. Talk to me about what that's like from your guys' perspective as a team.
Yeah, I mean, it's it's been, to be honest, like it's been a lot of fun, right, to see new features, and I think part of it is coming from Hyperliquid, but also other competitors. Like for example, Ostium, I think, was maybe the first to really lean in on real world assets, and now we've added FX. I think it feels like longer. I think it's been a month, right? And actually, like the open interest there has been quite, especially on the euro, like this has actually been pretty high. But I guess to your bigger point, I think like for us, like building on top of Ethereum is really important to how we think about the roadmap, right? And so really like the vision is that any asset on Ethereum can be collateral on Lighter and vice versa, right? A Lighter position can be actually kind of tokenized and live on Ethereum as well, right? So for example, like that's not possible today. I mean, I think that the tech for that is almost there. I mean, the one remaining piece is the ZKVM sidecar, which like we've been working on that for some time. We're gonna have some announcements around that in the coming weeks. Some of those ideas have actually been inspired by some of what Tarun has written about like 6 months ago, and other folks we've been talking to in the Ethereum ecosystem. But essentially, what that'll allow us to do, right, is like right now we have these custom circuits that can do order management, risk management, liquidity management very efficiently. But you can't, like right now, you can't just write a smart contract and have that run on Lighter. Like you have to implement everything as circuits. But with the sidecar, you would be able to do that, and so then those smart contracts will share the sequencer with kind of the Lighter exchange itself, and so that'll open up a lot of things like universal cross margin, like tokenization of Lighter positions, and so on. Like I think some of the
So should I imagine that is like that's a substrate on which Lighter is going to be shipping new features that allow you to compose things with your core Lighter positions, et cetera? Or this is like a developer platform a la Hyper EVM that's meant to attract a broader set of developers? Like how should I think about the Lighter VM?
Yeah.
Or the ZK
Well, some of
VM
it,
that you guys are shipping?
yeah. I mean, some of it will be. There's some features that our team will implement that we have thought about for a while already. Like for example, yeah, like tokenizing Lighter positions, or even like tokenizing LLP, right? That can live. Like you can actually just buy shares of LLP on Ethereum. So things like that we'll probably build directly. But yeah, other developers like Layer 0, Morpho, Aave, like all these protocols can live on top of Lighter once the sidecar is done, and we've talked to some of these teams already about doing that. So for example, like in implementing something like basis trading, right? Like that's not necessarily
So you can
I
just
think
straight up tokenize a basis trade within Lighter.
so. That's to make that work though, you need some form of lending as well, right? And we probably like there are already very established lending protocols on top of Ethereum. It's like kind of makes a lot more sense from our perspective for those to live on Lighter as opposed to like us building Lighter lend or whatever, right?
That makes sense.
Yeah, one thing I actually think is interesting about these RWA perps. So Vlad mentioned the euro is quite liquid on Hyperliquid, or sorry, on Lighter. Is there's significantly more volume in the FX perps than like the history of the euro stablecoins. If you compare like And it sort of makes me wonder if like people are just going to trade perps of FX and then only use USD. So like they want exposure to euro, they'll just do a basis trade of holding spot stables and long or short the perp. Because it's actually some of these like the RWAs are funny because the ones that everyone thinks will be the highest volume seem to never be, right? Like Tesla, I feel like Tesla has been this meme in crypto. Where for like the last 5 years, everyone who's like stocks on the blockchain would just be like, they're Korean people who want to buy Tesla. Like I feel like I've heard that pitch 5 million times since 2020. I don't know if you, Haseeb, you've gotten that also. But,
Yes, the cajillion times.
but then you look at the actual volumes on Hyperliquid and Lighter, it's like Nvidia's crushing it, or the index. Like I didn't think people wanted to trade the index on chain, right? Like it's sort of like, so I like really enjoy watching the RWA perps because like the leaderboards show me things I never would have expected to see on chain. Like,
No, I mean, I think it'll be interesting once you have, for some of these assets, like once you have the perps and the spot kind of on one platform, to your point about kind of FX basis trade, but also even with, we're talking to the Robinhood team about kind of tokenized stocks, right? I mean, there's some interesting stuff there as well, right? With spot versus perps, but also for imagine like for fixed income, right? Like we haven't that's not an area that has been explored that much yet on chain, but like you can do some, like imagine that you can have like a yield curve on chain and at the same time like trading the perps too, right? Like so I think there's a lot of interesting stuff, and yeah, I don't. It's hard to say right now, like which ones will get traction, which ones won't. But I think once you have the spot and the perps, that could change. Because at least like in TradFi, like a lot of trading shops, like their whole strategy only makes sense in the context of the basis trade.
So I totally hear you guys on that. At the same time, I also don't want to be Pollyanna-ish, which is that whether it's the RWAs that are being traded on Trade XYZ or whether it's like the forex that's happening right now in Lighter. Right now, all this stuff is pre-TGE, right? Trade XYZ hasn't launched a token. Obviously, Lighter hasn't launched a token, and we've all been in crypto long enough to know that there's some distortion. There's like some gravitational force that's exerted by token coming, and so one of the questions I have for you, Vlad, is once token's coming. You can check the poly markets to decide what date you think the token's coming, but token's coming. Once token comes, one thing that we have seen from every token in the history of anything is that the behavior TGE T-1 versus T+1 changes. What are you expecting? What are you preparing for? And like, how are you thinking about the before and after for Lighter has a token?
Yeah, I mean, we're certainly gonna continue to build and roll out new features, and I think there'll be a lot of interesting functionality that a native token will unlock, right? But yeah, I mean, just from like an expectation setting standpoint, like it's the old cliches, like it's a marathon, not a sprint. I mean, I think I think the team and the early community is not necessarily expecting something that'll be like a rocket ship on day one, but it will kind of start in a healthy place and then kind of trend upwards from there if we continue building products that the community likes. So I mean, I guess like the goal obviously isn't just like to maximize value on day one, but to have something that's healthy relative to the current state of the market and continue iterating from there, because it's not like, I think we've seen a lot of we've seen some tokens that have this like spike and then don't do well, and then others that continue kind of a steady grind, right? Which is, I mean, I think we've had a very strong growth cycle like the last few months, but at the end of the day, like we're in this for the long haul, right? Like we're here. Like there's a lot of technology to build here. There's a lot of innovation, and yeah, I think sometimes people might get excited about certain parts of the product for the right reason or the wrong reason, and some of it may have to do with, like, we're trying to, for example, like some of what we're doing now, right, is like if we see egregious examples of like points farming, which are basically like Sybil attacks, like that's not that's
I've
not
seen
fair
some
for the rest
chatter
of
on the
community.
timeline of you
Yeah,
guys just slashing people who are just
right.
flagrantly
Yeah,
engaged in
exactly.
farming behavior. Yeah.
Yeah, exactly. So there's stuff like that that happens, right? But and then there's anything from that to like real traders who may be trading a bit more aggressively than they would otherwise like. But but then of the day, there is, I think, across the space there is a lot of real innovation happening, and
Yeah.
there will be for the years to come, and we want to be part of it.
I mean, it's clear this is a big market. One last question on this front as well is like, I think the last time we spoke must have been in the summer. You told me that your North Star metric is not volume, it's not open interest, it's TVL. Is that still
Yeah,
true?
yeah. That is still true. And I think that the events of October 10th were pretty good validator of that, because there was a lot of noise around open interest and volume across a few platforms, and whereas I think TVL was actually like pretty pretty steady. So yeah, because I think at the end of the day, TVL is a metric that represents like capital that customers
It's a real
trust.
opportunity cost.
Yeah,
Yeah.
yeah,
Yeah.
trust us with.
It's
Yeah,
funny because
so
we were talking about this with the L1 debate, and we've like over the years invented so many new metrics for layer ones. Like, oh, there's REV and there's the Metcalfe's law and there's all this other stuff. But like the first metric we ever had for layer ones was TVL. And it has turned out, I think in retrospect, to actually be the most robust metric. That like in the short term you can game it, but in the long run, it's like really hard to have billions of dollars in TVL. It's
Well,
just really
also
hard. You can't will it.
in perpetuals exchanges, the TVL is mainly stable, so it has
Right.
less of this like cycling stuff.
Well, not
that you
anymore.
have.
Not anymore. Now with cross margining coming to a perp exchange
Yes.
near you.
Sorry, yeah, I guess we should add that.
yeah, I guess even right, like we now that we have ETH, I think like 2% of our TVL is now in ETH. But yeah, I mean, it's interesting because when I first got into the space, because TVL isn't really a thing in TradFi, right? So like when I first got into the space, I was like, this, like to your point about new metrics, like this is kind of a new metric for me, but it took some time getting used to it. But now I actually really see the value and how robust it is.
Yeah. It is very much that like 70 IQ, 140 IQ meme, I think is
Right.
TVL. I feel like it's aged very well. Okay, so one more kind of meta story that I wanted to get into that relates somewhat to this discussion on tokens is there's been a lot of drama lately about the dichotomy between tokens and equity and what happens, particularly in the case of M&A. So there was a story earlier today that Axelar got acquired by Circle. And when I say Axelar got acquired by Circle, of course, Axelar is a decentralized bridging network protocol thing, cross-chain message passing. And it was not the token that got acquired, but rather the devco that got acquired by Circle. It was basically structured as an acqui-hire kind of thing where Circle took this thing and basically like, yeah, token, go have fun. The token immediately went down something like 15%. I should note we're investors in Axelar. Tarun, are you guys investors in Axelar?
Yeah.
You are? Okay, yeah. So we're all investors in Axelar, so we all had tokens go down. I don't know if you guys already sold, but we certainly did not. So we had a fun little day today. And then, of course, there was another story a few weeks ago about Tensor, which of course was one of the large. They created Vector.fun as well as they were originally a big NFT exchange on Solana, and they got acquired by Coinbase. And interestingly, when that happened, the token, although like same story, acquired the devco, did not acquire the token itself. In that case, the token went up. Whereas when Axelar got acquired by Circle, the token went down. So maybe like Circle's not as bullish as Coinbase as an acquirer. I'm not really sure what that means. And then separately to all this, there was a third drama around Aave. And basically Aave, so of course Aave has the protocol. Aave, as everybody knows, has a big token. It's a big lending protocol. There's also Aave Labs or Avara, which is the company, like the devco that actually employs all the people and owns the IP. And Avara was, actually, I forget what the specific story was, but they were basically collecting fees off of something that was happening via the front end. Tarun, do you remember what this was?
Cow swap integration.
Cow swap. So basically one of the functionalities on the front end is that you can swap. And basically originally the fees were going to the protocol, but now those fees are getting swept into Avara, the company. much akin to what was happening in the early days with Uniswap, Uniswap Labs versus Uniswap the protocol. So these three stories kind of loosely related, but they all triggered a broader conversation about what should be the right relationship between tokens and equity. We talked about this at some length actually when Uniswap did their unification, where they united both the DAO as well as Uniswap Labs and stopped charging a separate fee on Labs versus the DAO. But the weird case here, I think with Aave, it's actually relatively straightforward. Maybe, I don't know, we could talk about that. But I think in the case of M&A of devcos, that does feel like also actually a pretty different situation than a sort of, a Labs double dipping with respect to getting paid something that maybe should be owed by the token holders. So that's the backdrop for this conversation. We've had a lot of people going back and forth about it. Tarun, what's your take on this whole drama between tokens versus equity, M&A? How does it all fit together?
The M&A thing actually reminds me a lot of like what's happening in AI, where like someone will buy the management team and then dump the rest of the company, like what happened to Character AI or Adept or any of these companies.
But in those they did pay a big fee to the company. They just didn't acquire the company. Yeah. So the shareholders still got a payout.
Yeah, I guess that's true. Although, yeah, it's true.
Like
I don't think the payout is uniform.
I don't know if it's uniform, but like if you literally just like acquired the people and paid them a bunch of money, there would be shareholder lawsuits. The fact that it's not M&A, that was mostly a workaround for like Lena Khan and all this M&A kind of scrutiny, but investors were still getting paid. So I think that's a different story.
Actually, that's a good point. There's no like token holder lawsuit rights, which I think
it's true.
Maybe that's like the real the real problem. Like
yeah.
Because like actually, I when I saw this, I was just thinking about this AI thing because I was like, oh, it seems like hiring the devcos a little bit like hiring the manager, like some subset of the company, but because like the foundation might exist and have employees, right, which is like the rest of the ecosystem. I think the Tensor one seemed, I don't know, it seemed fine because like isn't the product kind of like this kind of sunsetting or kind of the trailing off, whereas like Axelar I feel like it's a little bit weirder because in theory the network has a lot more assets secured by it, like there's like AUM. I don't know what happens. What are the rights to that if it turns out like the validators
so they handed off the
they have a foundation, right?
There's a foundation that's still capitalized, and that foundation is now being shepherded by another organization. What's it called?
Common Prefix, right? Common Prefix.
Yeah. You know Common Prefix?
Yeah.
Do you know them? Okay. Yeah. So Common Prefix is now taking over. It's a dev shop that's worked on multiple different chains, and so it maybe this is now their business is like taking over zombie chains and just running them.
Well, they were trying to launch this like non-chain chain, right? Pod or whatever.
Oh, is that right?
Or pods. Okay. Yeah. But Common Prefix is actually a bunch of like academics who work in consensus quite deeply. I think their name is one of the best names in crypto, but it is a very nerdy name. So.
It looked like a very impressive team, but it was like this, like, it all clicked moment where I'm like, okay, there are like, one of the things people complain about with FTX and the FTX bankruptcy is like all these like bankruptcy vultures who just like show up and charge insane fees. And I'm like, why wouldn't there be something like that for crypto? Is that like, okay, we say that chains can't go bankrupt, but like the people certainly are like, yeah, fuck this, I'm out. And in which case, shouldn't there be somebody who's just like, yeah, I'm going to charge you an arm and a leg. I'm going to take over your stupid foundation. I'm going to pay myself all the money in there, and I'm going to manage your stupid chain. And I'm like one of the only people who can do it. Not to say that Axelar is stupid, but like
I prefer the perspective of this because the devs beat the lawyers.
I'm right? Sure it's like a better system. I'm sure it's a better system, but like to be clear, I don't know Common Prefix. I just learned of them the first time, and I'm going to chat with them soon. But it would make sense that exists. Like there ought to be something like that, just given the way that crypto works, right? Like if it exists for companies, why shouldn't it exist for protocols? Because the normal thing is that it just goes into disrepair, right? It just like it's basically in the junkyard of old Dino chains that nobody even knows how to start up anymore. Like there's just some validator in some cloud somewhere that's still running, and like if anyone needs to fix it, it's like, oh, fuck that one's just going to get killed by a quantum computer. No one's ever going to go bother to go update that thing, Like,
I think you're right. There is something to this like vulture. Crypto has not had many vulture M&A advocate type investors, and I know a bunch of people who are starting funds right now for doing this type of stuff, of like token holder
Doing this type
advocacy,
of
and
stuff.
maybe no, but I think there's a version of the world where you're talking about the people who made money off the FTX estate. Imagine I'm
Yeah.
a fund that's doing token holder advocacy, but I'm actually just trying to buy try to get my company, whether my dev shop, to be the one that's. So I use my fund to buy.
Okay. So now we're introducing conflicts of interest and like self-dealing into the whole. Okay, great, perfect. We've
But I kind of
recreated
think
all
that
of traditional bankruptcy.
I think that's what's going to happen. That seems like
No,
the
I can see it. I
natural
can see
end
it.
state.
Okay, so I do have a theory on this, but Vlad, I want to bring you in. What's your perspective on this whole shareholder token holder drama?
Yeah, I mean, I haven't been following the specific cases. I guess we've been pretty heads down, as you guys can imagine. But I guess one thing I'll say is I feel like, I mean, again, I don't know the motivations for these specific deals, but like, I feel like there's a lot of untangling going on now from like I think the last kind of under the regulatory environment in the past, there was a lot of kind of like, I think what someone called like centralization theatrics, right? Of like kind of setting things up for, and not necessarily that, not like running a chain in like the way that's just like most efficient for its users, but like just having all these different entities. And so I don't know, but my guess is that maybe some of this stuff is like meant to like untangle some of those structures. But yeah, I mean, I think from like from our perspective, it is like, I think we do want kind of one, everyone who's involved, whether you're a team member or an investor or an early community member, like you're kind of all in the same boat and have allocation from the same pie. Like, I think having when incentives, and that to me, like that's part of like the magical things about crypto, is like that the opportunity to do incentive alignment. Once you lose that, then yeah, I mean, you get into, you might get into some unhealthy outcomes. But yeah, I mean, I have
So
wondered
I
about what
totally
happens
agree
to
with
these
that
zombie
take.
chains. That part, that's maybe a separate point here. That I'm curious what might happen there. But anyway,
Yeah. No, I completely agree. And this is the drum that I've been banging for a while, is that like you should have one asset and you should not have some smearing of value across two different assets, two different sets of investors, et cetera. This was the criticism that I levied against Uniswap for a long, long time on the show, as well as in other venues. And I think this is largely what's being echoed by a lot of people who are criticizing these deals. Now, we're investors in XLR. And so actually, I want to clarify that despite the little story I just gave about, oh, maybe there are these vulture firms, I actually think what happened here is totally fine. So I think like Mike Dudas, as well as a few other people, were like, "Oh my God, this is terrible. Circle's a bad actor. They're like cajoling people into taking these horrible deals." Look, Axelar, I think it's a great team. Their token's down like 85% or something from where we invested. Like normally, when a startup is down 85%, like it's time to call it quits. It's like basically, hey, didn't work. We didn't build the thing. We didn't succeed, and you like go you're not enslaved by your VCs or by the people who've brought you together, and to say, well, we have to just keep running this forever until we hit all-time high again. At a certain point, you just say like, hey, it's time to cut our losses because we're talented people and there are more useful things that we could be doing with our lives than just slaving away in the startup mines. And as an investor, it's kind of your job to be mindful of like the human capital that is actually embodied in a startup and that is best released when the startup is not working. Like obviously you try it for a while and you might have to pivot, you might have to, there are times when you have to go through the dark night of the soul in order to get to the promised land. It happens. But there are times when it's like, hey, this market didn't materialize. We thought interoperability was going to be huge. It's not huge. You guys built Axelar. It's great. Market doesn't think Axelar is that valuable. That's okay. It's totally okay for that to happen. Now, if you're a retail investor, retail investors don't think that way, right? Retail investors are like, how dare you? You created a token. You lost me money. You better, like keep working on this until I'm finally back in the money. Otherwise, I'll hound you till the end of your days. And that's part of the reason why people historically take venture capital instead of retail capital, because they know that venture capital is okay with the idea that, hey, you gave it your best shot and didn't work. It's okay. You can move on. So when Axelar got acquired by Circle, so I should also clarify, I don't know all the details of it, exactly how this was structured, this and that. I know the high level of what we're getting in this outcome, but from my perspective, like it's fine. I think the Axelar guys are talented. They should go work on something important. Circle's building important stuff. And if the market thinks that Axelar is not that valuable and basically there's not that much more to do on Axelar besides just keep it running, then, so be it. Good game, fair played. You guys put multiple years of your lives into this. That's all that an investor can ask for. So from my perspective, I don't think, and if you're Circle, you are under no obligation. I mean, this is really Mike Dudas's point. So I'm kind of subtweeting Mike Dudas right now. You are under no obligation to pay token holders for anything. They're not buying a token. They're acqui-hiring a team. This is basically an acqui-hire. So if you're acqui-hiring a devco, and the devco makes no money, the devco is just like a corporate shell. So if you're acqui-hiring a devco, you don't owe anybody anything. You don't owe token holders something. You don't owe the investors a big outcome. You don't owe anything. If the people who own the equity in that thing, which, if it's all safe, then the only equity holders are the founders. If they agree to the deal, it's a deal. And like token holders don't get a say in that vote. Now, I do think that there is a good argument to be made that is perhaps a flaw in the system. And to your point, Tarun, of like, hey, why don't, token holder lawsuits is basically like, why would a token holder lawsuit make sense? The answer is because maybe token holders should have a claim on governance of the devco. And I imagine that maybe there's a way that you can build that in, that perhaps there's like a protocol level ROFR in the devco docs, that if somebody goes in and tries to do a change of control of the devco, that the docs are written such that like the devco has to go and run a competitive process with the protocol and say like, hey, these people want to acquire us, but as a protocol, or as a DAO, you have the right of first refusal. You can buy us back if like somebody's convinced there's a better use for this devco talent than the protocol. But my guess is that, would the Axelar protocol pay up for the Axelar team? One thing that we've learned from these DAOs is that they hate paying for talent. Like I think probably one of the worst parts of DAO governance that we've seen is that they're just so cheap. DAOs are so incredibly cheap. They hate paying above market salaries or even market salaries. They like abhor market salaries, and like every single individual line item is overwhelmingly picked apart and criticized. Where like if you look at a corporate board or you look at VC governance, we don't do that. That's stupid. It's a really terrible way to retain talent and to incentivize a team. And so I don't know. I curious, Tarun, what's your take on this concept space of letting DAOs play a part in the devco retention?
It seems inevitable it'll happen. I mean, I feel like you've just created 5 jobs for lawyers who are listening to the show who are going to like open class action lawsuits tomorrow or something. Like,
well, you can't. I mean, you can't. No, I don't think you could. I don't think you have standing to sue if you were trying. I think that it'd be such a stretch.
You can make life horrible for the devco, though.
You can be annoying, frivolous. Yeah, but like you have to pay lawyers. I don't think anyone's going to take that on contingency. That's such a stupid lawsuit.
Having been party,
I don't know. Maybe I'm wrong. Maybe I'm wrong. Maybe eat my words. Maybe we've incepted this idea now into people's heads. Berwick Law is going to wake up and suddenly like have laser eyes and be like, boom. If you own Excel, let us know.
Haseeb, you and I both are party, or well, I guess I was party in the Lido thing, which was what I think there's lots of lawsuits that exist in the world that might be frivolous but take 7 years to adjudicate.
Totally. Yeah, but also it was a different regulatory regime at that time, so there was more sympathetic. There was more sympathetic judges. There was, like if you went through motion to dismiss today on a lot of those lawsuits, I think they would have succeeded today, whereas they failed at the time that they were actually initially adjudicated. So
yeah.
Anyway, we're up on time. Vlad, thank you for joining us. What should people look out for if they want to see what's happening with Lighter TGE coming up soon? Give us some alpha.
Just follow us, Lighter XYZ. We'll keep everybody up to date on the next 2 weeks. There'll be some a lot of announcements.
Okay, and Lighter points, prediction for Lighter points
for their value.
Yeah.
I mean, I think the market, it's starting to trend up a little bit again. So we'll see if it hits 100 pretty soon here.
Okay. All right. Is that the prophecy? 100?
I think we'll see some trades at 100, but but yeah, I guess those points markets are that's been kind of an interesting thing to watch throughout this process. But yeah, we're pretty much just staying heads down, and there's so much
Good.
to do. I mean, so yeah, definitely. Thanks for having me, guys, and
Thanks for coming. Well, next Tarun paper is going to be on points markets. So,
Dude,
Tarun, get it
I
chambered.
think after this time, I think it's the first time I've ever felt like I needed.
Have they beaten it out of you? Have the HL boys beaten it out of you?
I just think it's not just that. It's just like I feel like there's no value for this type of thing. It's like you might as well go do it.
You can't end the show like that. No, you can't just be like,
it's
true. Is this the beginning of your expert witness arc?
It's just kind of like, all right, if you're just going to be kind of.
All right. How about that, Tarun? We got to end the show on something positive. Tell me something positive.
I don't know if I have anything for you.
So you force it. Anything.
Justin Sun put $100 million in LLP.
There you go. His Excellency. All right. Good note to end on.
All right.
Thanks, guys. We'll be back in a couple weeks.